If you're considering bankruptcy in Canada, you may be wondering how this process will affect your income taxes. As the largest source of government revenue, income taxes have significant implications for Canadians in financial distress. When you file for bankruptcy, it's essential to understand how this decision impacts your income tax obligations and any outstanding debts. I will explore the income tax implications of bankruptcy in Canada, highlighting what you can expect during and after the process. Bankruptcies in Canada primarily focus on two types of debt: secured and unsecured. Secured debts, such as mortgages and car loans, are generally not affected by bankruptcy. Unsecured debts like credit card balances, personal loans, and income tax debts can be discharged through bankruptcy proceedings. Income tax debts may include unpaid taxes, interest, and penalties for the current year or previous years. In most cases, these debts are fully dischargeable in bankruptcy. However, there are some exceptions. If the Canada Revenue Agency, CRA, has registered a lien against your property before you file for bankruptcy, the debt may be considered secured and may not be discharged through the bankruptcy process. When you file for bankruptcy, you are still required to submit your annual income tax returns promptly. The main difference is that you will need to submit two separate tax returns, one for the pre-bankruptcy period and another for the post-bankruptcy period. Your pre-bankruptcy tax return will cover the date range from January 1st, or the first day of your fiscal year, to the day before your bankruptcy filing. Any tax refunds or credits that you might be entitled to for this period will be sent to your licensed insolvency trustee, LIT, as part of your bankruptcy estate. The LIT will distribute these funds to your creditors as part of the bankruptcy process. Your post-bankruptcy tax return will encompass the date range from the day you filed for bankruptcy to December 31st, or the last day of your fiscal year. Tax refunds or credits for this period will generally be yours to keep, not sent to the LIT. However, the LIT may claim some of these funds if certain conditions apply, such as if the refunds or credits are a result of unused RRSP contributions made before your bankruptcy filing. Once you've been discharged from bankruptcy, most of your unsecured debts, including income tax debts, will have been eliminated. It's important to note, however, that some tax-related debts do not qualify for discharge, such as those stemming from fraud or willful tax evasion. As you begin rebuilding your financial life after discharge, it's essential to stay current with your income tax obligations to prevent any new tax-related debt from accumulating. Remember, bankruptcy only addresses debt up to the date of your filing, so any new debt post-bankruptcy will be your responsibility to manage. When filing future tax returns, you'll also need to disclose your past bankruptcy to the CRA to prevent any confusion or discrepancies in your financial records. Bankruptcy and income tax matters can be complicated, and we've only scratched the surface of the many factors at play. If you're considering bankruptcy or trying to understand the income tax implications of your current bankruptcy, it's crucial to consult a licensed insolvency trustee. LITs are trained professionals who specialize in debt management and can help guide you through the process and provide tailored advice on the best course of action for your specific financial situation. Understanding the income tax implications of bankruptcy in Canada is a vital aspect of navigating the process effectively. By being aware of your obligations, filing the necessary tax returns, and working closely with a licensed insolvency trustee, you can find the best path forward for your financial future.